Thank you, everyone. Thank you for being with us this morning. I guess introductions have already been made, but I will ask my panelists to tell you a bit more about themselves before we start. So we've actually had a pretty good introduction already by Yvan earlier about, obviously, the massive tailwinds about private market over the past 5 years or so, over the past decade, really, but then really accelerating over the past 5 years in terms of, especially in terms of fundraising and new entrants in the market. That also came with platform players really kind of pushing into the private market space and private equity in particular. The GP universe continued to grow, and we saw really interesting sort of strategic developments during that time. Obviously, we're at a slightly different point in the cycle now, and what I thought we'd do today is get takes from sort of experts in the market around a few of these themes. Largely, are we at properly at an inflection point, and will GP universe look very different in, sort of, say, 5 years from now? Are we going to see more consolidation? Our stake sales, which obviously has been a huge sort of strategic shift in the market as well over the past few years, will that continue? Will that grow? But we'll also look at how GPs can grow organically and kind of evolve their strategy from the inside as well. So plenty to cover. We've only got 30 minutes, so we'll try and cover that as much as we can. But first, before I do that, so I'm Greg Gilles, the editor of private equity publication Real Deals, and I'll let my panelists introduce themselves.
Good morning, everyone. I'm Andrea Davis. I'm a managing director at Investcorp, where I have two roles as head of strategy for Investcorp, and I also lead the operating team in the European Private Equity Group. So I like to say that I have a macro and a micro view of the industry.
Good morning, everyone. Augustin Duhamel, managing partner at 17 Capital. 17 Capital is a specialist provider of financing against portfolios of private equity.
The microphone does not work.
Sorry.
Did mine? Yes.
I was told we wouldn't have to switch them on. So I'll start again. Augustin Duhamel, managing partner at 17 Capital. 17 Capital is providing financing against portfolios of private equity. We have raised $11 billion to date, specialized into that strategy. We do it through two types of financing, senior secured and preferred equity. And we provide that financing to funds, limited partners, and general partners, which we'll probably focus on today.
Good morning. My name is Mauro Moretti, and similar to Andrea, I have a couple of roles. One is I founded a business called Three Hills Capital Partners 12 years ago, and I chair the investment committee. And as we joke sometimes with Agustin, we actually do the same job of Agustin, but we do that with operating businesses, not for GPs. So we provide structural capital and hybrid financing to mid-market entrepreneurs and founders across Europe. And then I'm also the chairman of our holding company, which is called Atypical Partner, where we do some fun things, which I will explain later.
We'll get into that. Thank you very much. But first, I think if we look at the big picture, and we'll look into the various components of that as we go on, I think that there has been talks about now, are we going to see a bit of a shakeout in the GP universe between hyper-specialist platforms, a lot of developments over the past 5 years. I'd like to get your take on where do you think we're going to be in the next sort of 5 years or so? And if I start with you, Andrea, what are the main themes that stick out for you there?
Sure. Well, I think we have to acknowledge the fundamental shift in the investing landscape that we've seen over the last 12 months. But I think we also have to acknowledge that it's a cyclical industry. And the experience that some of us gained in the great financial crisis of 2008 actually becomes relevant today. I think it's worth thinking about in two frameworks. What we are doing as GPs and investors, and then a little bit about who and how it's done. And I think what we're doing is a continuation of a theme that we've been seeing for a long time, which is the real focus on fundamental value creation in the assets that we buy. And we've been talking about that for a while, but I think right now, in periods of macro turmoil, it's even more essential. So a big continuation in hiring skills and focusing on valuation. I think that's point one. And then point two is who is doing it and how is the industry changing? Well, this is a vibrant industry. We saw last night, we see in the halls today, there's lots of activity. And with a vibrant industry becomes opportunities. So we're seeing more niche players. We are seeing larger firms like Investcorp, where we are acquiring either skills in new asset classes or scale in some existing asset classes, as well as investing right now in organic growth. But we see niche players, and I think underpinning it all, and my colleagues I'm sure will talk about this, is a lot more flexibility of choice for what GPs can do.
Yeah, that makes sense. Augustin, what's your take on that coming from the financing side of it?
Well, if we take a step back at the last decade or so, and you mentioned it earlier, we've all benefited from massive tailwinds, which in my view has led to two things for the GP landscape. The first one is the growth in the number of players, a lot of new entrants coming to this attractive market. And the other thing is the growth of the existing players, which some of which have become massive. Of course, and Andrea, you're right to mention it, we're going into a different environment where, which will probably be a bit more selective for GPs going forward. We will need to go back to basics. We will need to make sure that the GPs who are staying in the market are delivering for their investors. And we will, as investors, either on the equity side or for us on the financing side, be ever more selective in the GPs we work with. So I think what we will see is probably a reduction of the availability of financing for those GPs going forward, with possibly a lack of financing for some of them, given that even in this new environment, we expect the private markets industry to still be growing faster than GDP. I think we are on a secular trend where our industry will still be growing at a faster rate than GDP. And as such, the GPs will need to keep up with the pace of the industry. They will need to find ways to finance their growth. And those types of financing will be more selective, again, either on the equity or on the financing side. Having said that, that will give probably more opportunities for those of us who are investing on that market, and hopefully better returns.
Makes sense. And Mauro, how do you see the GP landscape evolving over the next few years? More kind of specialist, kind of slightly left field strategies like yourselves, a bit more innovation. What's your key take there?
So I think there is a general rule of engagement, I think, in this sector, which is, because it's now a pretty mature industry, to come out and be needed by LPs, you need to come out with something different. Otherwise, they have already exposures to GPs with 10 years plus of track record. Why needing another, let's say, mainstream existing GP? So I think innovation is a need for people that want to launch and set up asset managers. In terms of where things might be going, the dynamics that we see today in the market is driven also by a big regulatory pressure. It's very expensive to run now an asset manager. And so if you are below a certain scale, we have seen it ourselves. We went from a vehicle of 15 million 10 years ago to now managing 2.5 billion. And you take time to really be a sustainable business. And secondly, if you are below a certain size in terms of AUM, highly probable you are single market in terms of geography. And being single market today, if you are involved in supporting businesses, might be a limitation, because every business is connected globally, wants to grow globally, to do acquisitions, to hire managers, and to learn, because entrepreneurs and CEOs want to learn. So having a single country focus might be a limit. So I think all these forces, of course, put a bit of pressure towards consolidation.
Yeah, that makes sense. And actually, we'll go back on the sort of geographic angle when we talk about consolidation a bit more. Just like to go back a little bit on the financing side and turning to you, Augustin, around the sort of the stake sales phenomenon, which has been a big talking point over the past few years. Maturing industry at some point, obviously, there's a need for liquidity, there's a need for these firms to evolve. How do you see that playing out? Do you expect a bit of a much like we'd see in the M&A market? A bit of a contraction as people kind of wait and see, or more of an accelerator into, oh, now it's changing, we need to do something?
Well, again, if you look back at what we have seen in the last few years, back in 2015, and Andrea, you probably have the same stats, hopefully, the volume of GP and M&A was in the region of 1 to 2 billion a year, when it was 15 billion last year and the year before. So it's gone up massively. Probably because GPs, again, were looking to finance their growth and to keep up with the market, and possibly as well because some of them were opportunistic and valuations were very attractive, and when you're offered that sort of valuations, that sometimes triggers a transaction. Now, if you look at 2022, or today, since January 2022, and you look at the public comps for alternative asset managers, the valuations have gone down by an average 40%. That is going to slow down the attractiveness of selling the equity in some of those GPs. And you also see that for those bigger platforms which were considering an IPO, and those IPO are put in the cupboard and not happening for some time. So my take is we will see more consolidation. Mauro alluded to it. We're an industry where size does matter. There are some economies of scale that you need to achieve as a GP if you want to be competitive in your market. We need to raise larger funds. We need, in some cases, to become multi-product managers, and that has a cost. That's the reason why a lot of people sold some of their equity before. They will keep on doing it to reach that sort of a size threshold. But I think the financing side of the market will develop even further, because it has the benefit of being non-dilutive. And yes, you're right, Mauro, we say that we offer the same thing. You offer non-dilutive capital for entrepreneurs, but I think it's easy to say, it's fair to say that GPs are entrepreneurs and they are running a business as well, and some of them don't want to dilute their equity, or at least not at the valuations that they are being offered today. So the market for financing, or for the need for capital, is still there in an environment which probably will shift the demand side with more demand for financing. And of course, I would say that because that's my business. But
no, that absolutely makes sense. And we're going to go back a little bit on consolidation, because obviously it's a big thing, regardless of how you finance it, and we can talk about that a bit more as well. But what I'd like to turn to now is what moves are we expecting to see there? What are the strategies that makes the most sense in the current environment? And obviously, Investcorp was a really good firm to turn to, because you have done a lot of these moves, and I'm sure you're looking forward as well, notably around looking at different geographies, but feel free to go into different products or different asset classes. What do you think are likely to be the key strategic shifts that we're likely to see there?
I think in any market going through the macro changes, turmoil that we're seeing, the key, and as head of strategy, it galls to say this word, but it's a little bit about being opportunistic on what's available. All of the geographies and all of the asset classes are not responding in the same way. So I think it's about, as a firm, we have 50 billion AUM. We recently closed an acquisition to scale up our US credit business. And we've recently also done an acqui-hire to bring skills also into our US credit business. So I think that is also coupled alongside organic growth. where we've gone into, for example, private equity in China organically. And in India, as it happens, inorganically. So I think, from where we sit, it's about looking at the opportunities in the different asset classes, as Augustin talked about, and looking for good managers that would fit culturally in the larger firm. And, that is a soft word, but a very important word as we think about the consolidation in the industry.
And when you mention growing organically in Asia, how did you go about that? Did you have an existing presence? Did you just scale it up? Was it
No, we set up from scratch in Singapore for Southeast Asia and in Beijing for China. And we hired people. It was a long journey. We hired skills actually into our European private equity team, worked with them for a couple of years in Europe, and then sent them off into Asia to create the team. So I think it's about, as I was saying, the culture, the people that join you to do organic growth or you develop internally, helping them understand the culture of the firm. But it's arguably less risky way sometimes of growing.
That's interesting. And on the US side, you mentioned obviously around private debt. Is that likely to be a key kind of area, fixed income and private debt? Is that likely to be a big?
Well, I think it is a key area for us. We've just invested substantially in it. I think we've got a large acquisition to integrate, so perhaps no plans in the short term for immediate further growth. But I think it is a good area. We've made a large investment.
Absolutely makes sense. And looking at more kind of organic, we've just talked about organic growth, especially in Asia for you, but that's from the perspective of a large platform, and no offense, I think THB is not quite there yet, but obviously you have grown very rapidly, as you mentioned, and you're working on a few different things in the background as well with Atypical. Can you tell us a bit more about your journey and how you see yourself kind of evolving organically over the coming years?
So I think in terms of where we are with Three Hills, we started doing something in 2008 which was a bit unknown to the market and even to us. We created this new approach of going to a family or a management team and say, listen, we are not a bank, but we are not a private equity. I come from BC Partners, so I was used to traditional private equity discussions, but I felt, and other people that then joined me in the journey, felt that families and management teams were in need also of something different, which was someone that could sit down with them and give them a different piece of the capital structure, but then help them as a private equity. So I think the asset class is there to stay, and it's growing very fast. Also because now entrepreneurs are evolving. There is a new generation of entrepreneurs which are also very sophisticated financially, and that they do the calculation of how much they can leave on the table if they sell less equity and they use a convertible or a senior equity. They know how to do that now. So our focus now is obviously to scale that business. We think can become pretty big. We multiplied by 10 the size of the fund in 8 years. We went from 100 million to 1 billion, the last one. Now I don't think we will do the same in the next 8 years, but there is a lot to do. And that's our focus. Now, in Three Hills, around the preferred strategy, we believe there are a lot of interesting things to still do with the skill set of the asset class. For instance, we just been awarded a B Corp as a management company. So that gives us a lot of credibility to potentially work on an Article 9 fund. But I'm not saying that, maybe. Could happen during the 2023. And then we said, when we look at the market in the next 10 years, we believe that actually hyper specialism, because Three Hills is a very specialized strategy, and that's why I think LPs found it interesting. So if the world goes towards hyper specialism, but a lot of people will be subscale to operate that. That's where the idea of calling our holding company, where the partners are Atypical, came, because we are actually meeting regularly people which we think do something very interesting, can have synergy with our world, entrepreneurs. We speak to entrepreneurs every day. Families, we have today 500 families and high net worth individuals in it's a small private bank if you think about. So, and we operate pan-European. So there are a lot of, variables in the matrix that we can see in some manager that maybe want to spin off, because we discussed before, you can launch a strategy or you can buy. But in reality, in our world, it's actually a bit less expensive to potentially seed someone that has done it somewhere else, and for whatever reason, they want to leave because they want to feel more entrepreneurial, and it might be a bit less expensive than buy, an asset manager. And so it's called atypical because on asset classes which are far from what Threads does, we like that the asset managers are the stars, and we are on the back helping them with the infrastructure, because to support Threads we have built a very sizable infrastructure for the AUM that today we have. So we enjoy it as Threads, of course, the most, but Atypical give us that flexibility.
I see. And Augustin, on your end, how operating in the same space, but targeting different needs, how do you see yourself kind of scaling strategically over the next few years?
So organic growth, I'd like to comment on that from two angles: the 17 Capital angle, the route we have chosen, and maybe from our client's perspective as well. If you look at 17 Capital, we started it 15 years ago, based in London. And it was pretty obvious from the early days that we had a very big market to capture in the US. But you need to be able to finance a US office if you want a presence there, and it takes time to build the AUMs that are capable of financing that. So we had to wait, and we only opened our US office, New York office, in 2016. Similarly, as I was saying, we have two products. We started with our preferred equity product. We are finishing investing our Fund 5. But it was very clear early on that there was a market for another type of financing against the portfolios we were lending. And that's a more senior secured financing at a more attractive price, even if with more strings attached. We had to wait to launch that new product, to be able to recruit more people in the team with more expertise, and we only launched it with a closing of our Credit One fund in April last year at 2.6 billion. Organic growth has its benefits. It's frustratingly slow, and we wish you could have done it much faster. So if I switch now to the people we work with, and I take the example of a GP we financed, they were a single product buyout manager in the US, mid-market buyout, and similarly to us, they identified an adjacent market opportunity that they wanted to enter into, and instead of waiting, they took our money to finance that new strategy, and we provided the management company balance sheet with financing that allowed them to seed the first investment of their new strategy before raising a formal fund and transferring those assets into the new fund when they came to the market and formally fundraised with limited partners. What they did allowed them to accelerate their growth as opposed to a pure organic growth, which is much smaller.
Yeah, and given the way fundraising is going at the moment, it might be a bit busier in the coming months with that. Yes. Absolutely, thank you very much. I think we've got a little bit of time left, but not very much. Are there any questions in the audience for our panel? You've obviously done an excellent job. Just mapped it out. Thank you very much for these really interesting discussions. Absolute pleasure to catch up with you. And thank you very much, everyone, for sitting there as well. Thank you very much.
Thank you.
Thank you.